Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I just let you have a quick look at the disclaimers, I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. Okay, I'll just run through what we hope to get through in the next 30 or 40 minutes or so. We'll follow the usual format, so we'll check out where markets are currently. We'll just have a quick focus on the bond markets because they are the key driver of the wider financial markets at the moment. We'll then look at equities and some of the technicals around the major US indices, which are looking like they're falling to major support levels. We'll then look at a brief review of last week's inflation data out of the US and the Eurozone before then looking at this week and the two central bank decisions that we had in the last few hours and the day before, the RBA and the RBNZ, that is. Before then focusing on the US, we've had some top tier data already, and we get that today actually. Before then, of course, the non-farm payrolls data on Friday. So we'll focus on that and all the repercussions for the dollar, as well as, of course, looking at the major currencies associated with those central bank meetings. Currently then, European bourses pretty mixed. US futures kind of giving up the initial gains. Price actions, as I say, really at the whim of bond markets at the moment. The dollar, that's been fairly defiant in the face of overt or possibly covert intervention by the Japanese authorities in dollar yen, but it is seeing some selling now. I'm just checking. Yeah, the dollar is slightly down now. Sorry, the DXY is down 0.28% or so. So some selling there. WTI and Brent really hampered by the risk tone generally, while gold is kind of flat, pretty much slightly down now. It's had 7 straight days of losses. I think this would be the 8th. So yes, that's where we stand currently. Just bear with me 1 second. I just want to pull up first of all the first chart, which will be the S&P 500. Just before we get to that, I mentioned about the bond markets, but the primary event in FX markets, probably yesterday anyway, and certainly today as well, speculation about all this yen volatility that we've seen, dollar yen hitting the 150 mark, which basically triggered a knee-jerk reaction, a flash crash really, where the major went from 150.15 down to 147.30 in a matter of seconds. While that not really confirmed that there was intervention by the authorities, it has left markets really speculating whether it did take place or not. Of course, the dollar had a strong session as well, so that kind of complicated the issue slightly. If we just cast our minds back last September, October, the Ministry of Finance in Tokyo, they embarked on $70 billion of intervention, and Tokyo at that time was quite happy, if you remember, to confirm intervention had taken place, and they were really quite sort of vocal about that. It started at 146 in September, last September that is, and didn't stop till dollar yen was trading near 152 in October. The issue now certainly is with strong US 10-year Treasury yields. They have a high correlation to dollar yen, but then certainly, of course, also we have this poor risk sentiment and as well potentially the unwind of the carry trade, which will possibly give some support to the yen. So much speculation about whether they have intervened or not. If we just actually bear with me 1 second, we'll just check out the price action in dollar yen at the moment, just before we get to stocks, which is here. So you can see we just moved up to 150.16, actually the high. Before then we crashed lower. You can see that move here on a very short-term chart, popped up above 150 and then right down to 147.27 or so, and then sort of back to 149, and we're just trading just above 149 now. Really interesting price action, of course, speculation rife about intervention or not. Potentially not, because they haven't followed their potential usual process about asking for bids in the market with trading desks, but of course, markets on red alert and may possibly push up slightly. As I said, we got up to sort of very close to 152 around intervention that we had seen last time. That was the first time, I think, since 1998. So it's a rare occurrence, but potentially markets on high alert for that. Otherwise, the big move I mentioned has been in bond markets, of course, and especially yesterday. I just want to pull up the 10-year US Treasury chart, which is this one, and it's very rare. Let me just go to the daily. Actually, you can see yesterday's price action. It's really rare that we get a sort of 10 basis point uplift in the 10-year US Treasury yield in one day. We got that yesterday, and we've had over 50 basis points of an up move in the past 3 weeks. And just to put that into some sort of context, this is really key for the dollar, of course, but it's the repricing of the Fed, which has really kicked off the low point of the cycle now, which is seen in 2 to 3 years' time. That is priced at above 4.5%. And just a few weeks ago, at the start of September, that was around 3.7%. So that kind of gives you a guide of this move that we have seen, this up move in yields, bond markets getting sold very sharply, very aggressively. That means yields go up, and we've seen then the repricing in the Fed cycle, as I say, and that the higher for longer narrative is absolutely key at the moment in markets, driving these bond markets and driving the dollar higher. Just on a basic level as well, so treasuries, if you don't look at these very much, US treasuries, that is, they essentially set the long-term price of money, as it's essentially the it's essentially the risk-free rate, with the 10-year Treasury essentially being the global proxy for borrowing costs. So if you think about yields like that, then Treasury yields, especially US Treasury yields, they tend to have a sort of pull on other markets. So varied asset classes like gold, US stocks, euro, they all hit lows, say at the end, towards the end of last year, but they're now falling lower. And that's because yields are going higher, and the cost of borrowing is rising quite sharply. And we're seeing that in global yields for sure, but of course, everybody is watching the 10-year Treasury as well. And you can see just the breakout on the monthly chart even. That's probably a decent chart to look at, but you can see this sort of bullish consolidation here around 3.5%, just above really, around 3.5–4%. You can see bullish consolidation there above that previous high from back in November 2018, which was at 3.25%. We didn't push much lower below there for very long, and then bullish consolidation, as I say, in line with the long-term trend, and then this breakout, strong breakout above 4%, above 4.33%, which is the previous high, and we're now racing towards 5%. You think that would probably be the goal before possibly then some more consolidation, and we'll see how other markets cope with that sort of level of the 10-year yield. Okay, moving away from that, otherwise in equities, well, large parts of Asia are on holiday with China's Golden Week, so just bear that in mind with Asian price action. Otherwise, China, we have had data over the weekend, just gone, PMI data possibly suggesting the downturn in China has stopped. The economy potentially has troughed as well. Of course, there has been focus on the US Congress agreeing that stopgap spending bill to fund the government until November 17. So that avoids a shutdown for now, but it could, of course, be a temporary reprieve as we will potentially go through this process in less than 45 days' time. November 17 is the day of that next sort of issue potentially. Just remember the next Fed meeting is before that on November 2nd. So that could possibly weigh on Fed officials' minds at that meeting as we go into that sort of mid-November date. As for equities, let's just pull up the chart and the weekly chart of the S&P. Well, where are we? Major indices, well, they posted their worst quarterly performance in a year last Friday, that was, and the first negative quarter actually of this year, 2023. Of course, it's the higher for longer message that is reverberating through markets. The S&P 500, that notched a 3.7 decline since the end of June. That was its first negative quarter in 12 months. And then the tech-heavy NASDAQ, that dropped over 4% in the quarter. That marked its biggest quarterly drop since the 3 months to the end of June 2022. Really, then it's interesting. Of course, we've got expectations that inflation will slow, but then markets, of course, have been grappling with interest rates, as I say, remaining higher for an extended period. And then investors, of course, also weighing the impact of surging oil prices, which have risen over 30% in the past 2 months alone on lower global output. Yes, so really affecting equity markets, risk markets, these higher treasury yields, and especially tech as well. Yesterday, certainly we had sort of FAMMAG, the Magnificent Seven stocks in tech, those mega cap tech stocks really suffering and have been suffering over the last few sessions for sure. Yield sensitive real estate as well underperforming yesterday, while defensive and value sectors, they're kind of holding up slightly better. But yes, we can see on the weekly S&P 500 chart here, you can see just this rollover in the last couple of weeks, and now it's not very clear actually, but I just wanted to point out these fib levels here. Actually, you can see a sort of short-term fib level from the March lows, that March rally. We're now getting towards the halfway mark of that of 42.11 in the S&P, and then we have a wider fib level of the sort of October rally. That's a 38.2, and that's at 41.81. So just want to stress this sort of confluence of technical indicators around sort of 4200 or so, give or take, a bit higher and a touch lower. But around the 4200 mark is a key level of support then for the S&P 500. You've got that 100-week moving average as well. That's a 41.91, that gray line. And if we just go to the daily, then you can see the 200-day moving average, widely watched indicator at 42.01. So just keeping in lots of dotted lines, don't really like to, but you can see around 4200 key zone of support for the S&P 500. If we do move lower through that, then certainly we go down to this sort of area of sort of sideways trading just above sort of 4100 or so. So that's the S&P 500. Look at the NASDAQ now, just on the weekly. Again, we sort of pierce possibly this long-term uptrend support line, and then potentially near-term support is 14,432, which we're not quite at. And then below there, we're probably down to this fib level. You can see I've got from the where these lows here in January actually, so this rally and then the 38.2 is at 13,932. Let's look at the Dow as well. Key level of support has been broken, the 34,281 we've been highlighting over the last few weeks and months, broken down through that quite sharply last 3 weeks now of losses, and we're really approaching them probably near-term support around the May low at 32,586, and then possibly the 200-week moving average at 31,744. You can see on the Dow we've broken that 200-day moving average, and now, as I say, we're probably getting towards this 32,586 level, which is that May low from earlier in the year. Okay, let's move on to now. Just bear with me 1 second. Let's just move on to last week's data. And we had the US inflation data, the headline PCE, that met expectations actually, as it rose to 3.5% year on year from July's upwardly revised 3.4%, while the month-on-month print was higher at 0.4% versus 0.2 prior and 0.5 expected. Core PCE, however, that cooled, and that's this chart here, that cooled to 3.9% year on year in August, as expected, from actually a prior 4.3%. It was actually the lowest level in almost 2 years, and the 0.1 month-on-month increase was down from a prior 0.2%, the previous month, and expected. The core services PCE ex housing, that's Fed's one of Fed's key measures, that also cooled as well. So inflation kind of continuing to decelerate, and you can see that from this chart here again, and really meaning the Fed's sort of policy rate hiking cycle is kind of working. But of course, the challenge is that the core PCE still remains almost double the Fed's 2% target, and that is, of course, then prompting the Fed to keep the chance of another rate hike in play. I think also important, just from Friday's data, income and spending data, that really pointed to the US consumer being in really good health, and much better than expected. That data really was robust. Real spending increased 0.1% month on month after a 0.6% gain in July. That kind of means we're on track for real consumer spending of around 3.7%, which would really push GDP growth to around 3.5%. So healthy. And there were also significant revisions to some of the numbers, with incomes revised higher and consumer spending lower, which really implies more savings. Those pandemic savings accrued during that time, they haven't run down as quickly as previously thought, and that will potentially hold up GDP growth in Q3 and potentially Q4 if we do see strong consumption in the final quarter of this year. That really then cements that higher for longer narrative, if you like. Although, of course, there are headwinds coming into Q4 as well, from just general rising gasoline prices, of course, less credit availability, and as well the restart of student loan repayments, if you like. So that was the US data. I think the Fed funds now pricing in just below a 50-50 bet now of a December rate hike, but I've also mentioned as well that repricing further out in the Fed curve of the higher terminal rate being, much higher, as I said, than even only a few weeks ago. Otherwise, we also had Eurozone inflation data. You can see a quick graphic of review of the numbers. 4.3% was the headline, dropping from 5.2 in August, and well below as well expectations, or 0.2 below the 4.5% estimate. Core inflation, the headline, that was the slowest pace since October 21. Core inflation, that fell as well to 4.5% from 5.3, below consensus expectations of 4.8%. That was the biggest drop since August 2020. So really good news for the sharp drop. Of course, weak demand and base effects really impacting inflation favorably. But we have to remember higher energy and wage costs do potentially keep the risk alive that inflation could remain above target for longer than hoped. Just digging in, services inflation, that may have ticked up month on month and remains high still. And then there are differences actually between Eurozone in the region, between the countries, and that is primarily driven by how energy translates to consumer prices, but also by differences in wage growth and economic performance. Going forward then, it's really those higher oil prices potentially that are the concern for inflation in the region, of course, and elsewhere as well. Energy prices didn't fall as much as expected in recent months, and they're probably now set to contribute positively to inflation. I think economists really, they mainly think Eurozone inflation could start higher at the start of next year, with a possible contribution of around 1%, I think it is, to headline inflation. So just bear that in mind, potentially this slowing up in this downtrend that we have seen. Of course, that is well below last year's impact, but they're then still sizable enough to prevent headline inflation from hitting the ECB's 2% target as soon as forecast. As well, going forward, then the questions will, or the big question really is around possible significant second round effects. That implies questions around pricing power, although of course the current weaker economic environment does imply that pricing power is weakening, and that is as well something to bear in mind. Of course, higher energy costs, wage growth as well, sticky wage growth could potentially mean sticky inflation, of course, and that means then higher for longer in the Eurozone as well. Today, just moving forward then, just bear with me 1 second. Sorry, bear with me 1 second, just lost a couple of things here. Yeah, so that's Eurozone inflation, and you can see the chart there, this nice downtrend as well in the core, which is key for policymakers, but potentially, as I highlighted, we may get a turnaround in that with these higher oil prices. Today, moving forward then, we do get comments from Christine Lagarde, ECB president. She delivers a pre-recorded welcome address. Actually, I don't think there's much that has been said. We also get a few ECB speakers, De Guindos and the Dove Panetta speaking as well. Money markets, I think they've virtually priced out now any further ECB tightening in this cycle, just sort of 3-4 basis points, if that, now priced around the turn of the year. If we just move to euro dollar now, just bear with me 1 second. That is here. And we can see really long-term downtrend, really still stuck in this bearish channel. Again, series of lower lows, lower highs, really neat channel. And yes, that's where we are currently. If I just go to the weekly, actually, you can see, well, last week, actually, we were potentially forming a hammer candle, hammer signal, which would have supported the impression of a low developing around the week's test of the 105 area. That didn't really pan out though, and any gains above 106 were sold. And then we did have, of course, those quarter end flows weighing on the dollar just in the last few days of last week. That has turned around, of course, this week, although you can see the big sell-off on Monday, and then new lows, of course, for the move at 104.48. But interesting, we are getting a slight pickup today. Kind of think that gains would need to extend, well, certainly above 106 to change this long-term downtrend, and then we'd get up to the top of the channel. So 106 key level of resistance. We have to break that really to change this long-term downtrend. Otherwise, yeah, support now at that near-term low, 104.48, and then below that, we're looking at sort of, well, we've broken these lows, of course, and we're now down to sort of 104.05, you can see, which is the halfway point of this big rally that we've seen, obviously, from the October lows last year. The halfway point being at 104.05, which would still be in that bear channel. Excuse me. Okay, that's euro dollar, and the main data from last week. This week, just bear with me, we've had, of course, two rate decisions from central banks. Firstly, we had the RBA on Tuesday. Just a quick review of the numbers really that they've been looking at and deliberated over. It's the first meeting actually presided by Michelle Bullock as the governor of the RBA. She kept, the bank kept its policy rate unchanged at 4.1% for the 5th consecutive month. The bank basically assessed that higher interest rates are working to establish a more sustainable balance between supply and demand in the economy, and will continue to do so. But of course, given the higher degree of uncertainty on future developments, the RBA maintained pretty much a wait and see data dependent attitude for now. They still see goods price inflation has eased back further, but prices of many services are continuing to rise. And of course, fuel prices have risen noticeably of late. So the bank, the RBA, holds its sort of assessment for CPI to fall back within the 2 to 3% target range, still in late 2025. So their view kind of is rather benign and reinforces the consensus stance really that the tightening cycle is over, and they're just adopting this wait and see attitude, as I say. Markets do price in around a 10%, do price in around 10 basis points of rate hikes by December. So around a 40% chance still of a 25 basis point hike. But probably the analyst view really is around this, as I say, consensus view that the tightening cycle is now over. If we just pull up the Aussie dollar chart, kind of not that representative of the Aussie as such, because it's obviously got the dollar leg in, and we've seen how strong the dollar has been. But you can see we did have, of course, that long-term sort of tracking sideways, 66, 68. Then we broke down through that, and we're sort of trying to build a base around 64 for quite a few weeks, August, September. But then we've broken down through that this week on the RBA decision, actually. And this isn't a weekly chart. Let's just take that off. But if we do move to the weekly chart, then you can see that breakdown now. So that was really bearish consolidation. It wasn't trying to build a base, but really for us now, bearish consolidation. We're now moving down. If we do hold that break on a weekly close, then we're looking at probably these levels around here, 62, 72. Yep, that's probably initial support. Before then, that long-term low at 61, 69 potentially, if we do get this confirmation of a breakdown below sort of 64. Yeah, the Aussie really been caught in the crossfire of, as I say, those higher US rates, and then, of course, deteriorating sentiment, basically broader risk sentiment, and as well broader Chinese sentiment, which has been deteriorating recently. Whether that now is in the price, of course, and we can possibly hold up, we shall see. Also, we had the RBNZ overnight. Actually, they also maintained their official cash rate at 5.5%, widely anticipated by both markets and consensus. Really, while risks to the growth outlook were seen as balanced, the overall tone actually in the press release was to the dovish side, and you can see we have seen some selling in the Kiwi. The RBNZ maintained its forward guidance and left that unchanged, signaling that rate hikes are most likely already over, but the rates would remain at restrictive levels for a more sustained period of time. But markets, and this is crucial, had speculated that we would have a modest chance of the RBNZ returning to hiking going forward. So the guidance was slightly a dovish surprise, really, and that, as I say, has caused some selling in the Kiwi. You can see there, although we have pulled back as the dollar has been sold generally. So still we're holding around 59. We didn't quite get to the previous lows in early September at 58.59. We got to, where do we get to? 58.70, so just above that level. So that is strong support for sure. If we do break down through that, which again looks similar to the Aussie chart, then we're looking at 57.31, a sort of minor fib level. Before then, that long-term low at 55.12. That's some way off. So as we're still keeping that support around 59, that is critical, and just below potentially for buyers. But just watch, as it could be, of course, bearish consolidation before the breakdown. Okay, this week then, I said we move on then to well, the US, and we've had some top tier data already. We had the ISM manufacturing PMI data on Monday. That had an upward surprise. I'll just pull up the dollar chart here, first of all. That you can see here. Just bear with me 1 second. Yep, you can see that there, the DXY chart. Just before we get to that, yeah, with that data, we had an upside surprise from September manufacturing ISM, 49 from 47.6, and consensus was actually 47.9. That was the third consecutive increase, with the headline number matching the highest level since November 2022. And the graph as well of that ISM figure sort of showing a tentative bottoming out pattern potentially. But it really shows the resilience in the US data. Details showed improvements in new orders, new export orders as well, production and employment, with the drawdown in inventory slowing. And together with a less dire activity picture, prices paid fell for the 5th month running, with the pace fastening actually. So that really brought sort of those soft landing themes, narratives, vibes, which is the Fed's preferred scenario. Falling prices, but still quite resilient activity. Yeah, interesting data, strong, still relatively strong data as well. Today we have the services ISM data. The headline seen peppering a touch to 54.0 for 54.5. So that was the ISMs. We also had some jobs data. We get a lot of that this week. Of course, the JOLTs, the vacancy data that added again support for rates staying higher for longer. Job openings unexpectedly rose to 9.61 million. The July was revised higher as well to 8.92 million. So the ratio of jobs opening to unemployed still declined to 1.51 from 1.53, but that really reflected that sharp recovery we're seeing in labour force participation. Otherwise, labour market conditions, they do remain tight. If you remember, this data hasn't been really looked at, but has been, of course, since the pandemic. Those numbers, the JOLTS numbers, vacancies, basically, they were 12 million, around that 12 million mark during the pandemic, and that compares with a long-run average of around 2.5 million. So it's quite something when we're still near 10 million in, of course, light of inflation where it is, rates where they are, and of course sentiment, all being headwinds that should be hurting the economy more. And that kind of highlights how resilient the data has been. Today we do get ADP payrolls. Kind of has a pretty patchy record really of predicting non-farm payroll, even though some commentators like to highlight the moves in that data. But really it's all on then Friday's jobs report. We do get Fed speakers, and we have had quite a few already this week. Fed's Mester and Bostic yesterday, I think, acknowledged that the recent tightening in financial conditions would likely weigh on growth. Neither appeared really overly concerned, with Bostic noting that businesses would not be affected by beyond what would happen in a normal tightening cycle. Okay, let's just move now to non-farm payrolls and just the preview here that you can see on the graphic. So the rate of payroll additions expected to cool in September, with the consensus looking for around 160, I think, to be added to the economy. Previously 187, of course. That consensus figure may change slightly if we do get better initial claims data tomorrow, after, of course, the JOLTS data that we have seen. Analysts still expect the unemployment rate to tick low to 3.7 from 3.8. Just for reference, the FOMC, their most recent economic projection, sees the jobless rate ending the year at 3.8%. I'll put that on there. As always, there will be close attention paid to the wage numbers, with the rate of average earnings seen rising at a pace of 0.3%, quicker than the 0.2 actually seen in August. I think year on year is around 4.3% expected. But certainly gauges of labour market strength, they continue to point to a strong jobs market. Indeed, the Fed recently tweaked its assessment of US economic conditions, noting that economic activity has been expanding at a solid pace. Of course, job gains, well, they have slowed in recent months. 3-month average sort of veering on sort of down towards 160, 150,000 now. So way below the sort of 3-month average that we had seen around 400,000 just 18 months or so ago, really. But they remain strong still at this point in the cycle. And of course, the unemployment rate remains relatively low. As I said, the Fed forecast for the unemployment rate at 3.8%, but that was moved lower from 4.1%, if you remember, at the recent meeting. Bottom line then, data probably not going to be weak enough to reverse the Fed's relatively hawkish stance. And that means it won't also reverse the strong dollar trend that we have seen unless we get a really outsized report. And you can see there, as I said, sort of a near coin toss chance now of that Fed rate hike by or in November or probably in December. If we just look at the DXY charts here, and that is the weekly chart that you can see. Just bear with me 1 second. Yeah, you've got that here that you can see, and it is these 12 consecutive weeks of gains now. I think we're into now. Incredible run, not seen since, well, a very, very long time. If I just pull it back, yeah, 2014 was probably the closest period, but I don't think if we do make this 12th consecutive run, we've got to go way, way back, as you can see. So yes, big run. Up over, I think, 7% from the lows, and you can see upward channel, basically the opposite of the euro dollar if you turn that on its head, because the euro, remember, has around a 57% weighting in this index, the DXY index. So the opposite of that, so series of higher highs, higher lows, but we are getting now towards that halfway point of the decline. That's a 107.17. We can just see we just backed off that. Actually interesting, yesterday popped above it, 107.34, but then quite a weak close considering we did close higher than yesterday, but still closer to the lows than definitely those highs. Possibly a bearish candle there, inverted sort of hammer candle if you like, although we didn't close that close to the lows. But yes, now we're down and we're back in the ascending channel. So interesting whether we do push up after this sort of period of consolidation. You can see we're overbought on the RSI there as well. It should be expecting some sort of consolidation, if not correction, but it could be healthy if we stay in this channel. Otherwise, we need to drop below sort of 106 for sure, and probably 105.65 to break this very strong uptrend. Okay, that is all we have time for today. We'll wrap it up there. Hopefully that's been of use to you guys. Great speaking to you, great having you all on the call, and we will speak to you in next time, a couple of weeks, I think. Okay, take care out there.